Welcome to TheoTrade. This is Don Kaufman. Here we are, October 11th, 2017, and the grind goes on. What am I talking about? Well, a whole lot of Fed-fueled insanity today. Speaking of the Fed, the FOMC minutes came out today and did absolutely nothing to the broader markets. And that grind is specific. The S&Ps continue to grind higher. The Nasdaq futures ultimately grinding higher, ending up in the day about 17 points. Markets just closing just a few moments ago. But let's throw this into a little bit of perspective over here. The trading week kind of at large. What you're looking at here, the three lines that are on your screen specifically are expected move. This ultimately being precisely where the week started. Roughly speaking, the week started at 25.50 in the SPX. Here we are. I know everybody's looking like, oh, we just keep trading to the upside. I mean, really, is this an upward momentum over here? We're 5 points higher. That's 3 days ultimately of trade, and we're only 5 points higher from where we started the week. So grind or not, hey, listen, it's a low volatility climate. And for those of you that are intraday traders, there's still more than enough movement and enough action under the intraday basis to make it worth your while. What am I talking about? Inside of the Nasdaq, for example, you know, people get very myopic when they trade on an intraday basis. They have tendency to say, you know, I'm an S&P futures guy, or I'm a Nasdaq guy, or, you know, I'm a bond trader. Well, having a little bit of variety can't necessarily be a bad thing, because there was enough action, if you were ultimately on the right side of it today, inside of the Nasdaq futures. The Nasdaq futures having a range, roughly speaking, from 6,055 all the way up to 6,085. So, you know, can you go wrong with about a 30-point or a 30-handle range inside of the Nasdaq futures? Now, I point out the Nasdaq futures because this is really where you got to feel like, if you're looking at markets and what I kind of call Fed-fueled insanity, it's this is the epitome of it right here, is inside of the Nasdaq. You have to look at this in a little bit of shock and a little bit of awe, how far we've ultimately come. Now, the reason I'm bringing this up is the psychology of this marketplace. And for those of you, if you don't tune in on a day-to-day basis, listen, I rarely ever discuss any psychology in the marketplace, but I think it's fitting at this point because the psychology of the marketplace right now is playing a key role. I continually hear traders, this can't go on. You know, this is too far gone. As long as you have traders still ultimately saying that, it can go on, and we could still grind further and higher. Now, I myself am still carrying some bearish positions, and I look at moves like here in the Russell, and I think the Russell is just exemplary in this in the psychology of this. You look at moves like this in the Russell, where the Russell was ultimately flat on the year, is now up about 10%. And no matter how much you look at this rally and you think to yourself, it can't go on, you know, I got to get short here, I got to get short here, you start hitting levels of futility. Okay, now the insanity that I'm seeing over here isn't about the grind one direction or the other. The insanity that I'm referencing is that it is a grind, that the implied volatilities are so incredibly low, that the realized volatility, for those of you that don't necessarily look at realized volatility, and again, I'll take off these expected moves here for just a moment. We'll go back to just a default chart on the SPX. And one thing I like to do once in a while is just pull up a study, okay? Under here, add studies, go down to volatility studies, go to historical volatility. Better known sometimes as realized volatility. And you want to talk about shocking. Now, this historical volatility, okay, is, it says 20/annual. What that ultimately means, it's kind of averaging together, all right, a period of about 20 days in there. But we're going to knock that down to give you kind of the realized volatility or the historical volatility, and even a shorter take on that. Knock it down, for example, to just the most recent 5 trading days. Hit apply, hit OK. The irony of that is there's actually been an uptick in terms of historical volatility, that we're talking about levels here, okay, where markets are literally, they're just not moving. And that, to me, is ultimately some of the insanity kind of at large. And by the way, yes, you can look back over 3 years, you can look at 5 years. In terms of realized volatility, we're there. I mean, again, one of the lowest points of actual market movement really ever recorded, we're there right now. And that's one of the perspectives I just wanted to provide you really quick. That's what I look at as a trader. But at the same time, I recognize there's still a lot of opportunities, again, on an intraday basis. There's plenty of opportunities to take positions. Just yesterday, we took a bit of a bullish position inside of the TLT. Now, for those of you that don't necessarily trade the TLT or trade the bonds, the bullish position inside of the TLT is pretty straightforward, right? We're just buying the 2350s, okay? Buying the 2350s and ultimately selling the 2550s against it. It's trading for just under $1 over here. It's a $2 wide call spread, a $2 wide call spread, trading for about $1. We're trying to achieve about a 55% return on our risk. Why do we select a trade like this? Well, ultimately, we figured we could see some decent movement based on the FOMC minutes that came out today. The irony is not so much, but I like the beginning of what appears to be a little bit of an uptrend here inside of the TLT. Hence, we took that, again, that bullish position in the TLT. Now, to kind of continue on over here, so the S&P's just grinding it out this week. Volatilities inside of the SPX, I mean, really lower than anybody's ever seen before. And I'm talking about, again, the implied volatilities here. If you look at like Friday's implied volatility, granted, we still have Thursday and Friday trade left. The expected move through Friday's close is still only $12.34. Talk about, again, a low range over there. And I'll reiterate this time and again, there's no way that I'm comfortable selling this type of implied volatility when the at-the-money options, okay? Again, here we are at 25.55. The at-the-money options are ultimately trading for 4.5% and 5% respectively. The straddle is trading for about, okay, $9 and change. Think about that for a second. You can buy a straddle inside of the SPX for $9 with still 2 full days to trade. This is a product that, historically speaking, has been it made $9 moves in a matter of minutes in the past. Okay, this is redefining, obviously, a grind and some low volatility out there. So the reason I bring up that straddle, the reason I'm bringing up the low volatility, you have to recognize we've got financials. They're coming out with earnings here. All right, they're coming out tomorrow, Thursday, obviously, a bit on Friday over here. The volatility is pumped up inside of the financials. And again, I have to reiterate this time and again, the financials have been the driving force to the most recent rally to get the S&Ps to the 2550 mark. There's a lot to think about, again, in what is a low volatility climate in the next 24, 48 hours of trade over here between Thursday and Friday. A lot of information is going to be unfolding from ultimately what? Some of the earnings announcements out of the banks. All right. Many people are still going to be sifting through those FOMC minutes that came out, although markets had zero reaction to the FOMC minutes. Lots to think about this evening. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.